Imagine this: a mining company losing money for years suddenly becomes a real estate business. The new owners start using the old mining losses to reduce tax on their property profits. On the surface, everything looks legal, but the CRA and later the tax courts saw it as a plan to sidestep the rules. I'm Amandeep Singh, CPA and founder of Cloudriver CPAs in Burnaby. Think of us as Google Maps for corporate tax, helping businesses owners avoid wrong turns and CRA red lights. Coming back to the case. In Madison Pacific Properties Inc. versus the King, which is a 2023 Tax Code of Canada case, the CRA challenged a complex series of steps that looked smart on paper but failed under the General Anti-Avoidance Rules, also called GAAR. Here's the story in simple language. A public mining company had over $80 million in unused tax losses. Two real estate investors, Madison and Vanak, saw an opportunity. They wanted to use those losses to lower tax on their real estate profits. But there was a problem. If they took control of the mining company directly, the tax losses would just disappear under the rules. So they came up with a clever plan. First, they spun out the mining assets, which means they moved the company's mining business and properties into a brand new company. Think of it like taking all the mining stuff out of an old box and putting it into a new box, leaving the old box completely empty, except for one thing: those valuable tax losses. Then they turned that empty shell company into a real estate company. They transferred their own rental properties into it and renamed it Madison Pacific Properties Inc. Now, the company had a fresh business, real estate, but it still carried all the old mining losses they could now proposedly use. To make sure CRA could not say that they had acquired control, Madison and Vanak took almost all of non-voting shares instead of voting shares. Here's what that means. Voting shares simply let you decide who runs the company. You can elect the board of directors and vote on major issues. Non-voting shares give you ownership and profits, but no say in decisions. Madison and Vanak took just under half of the voting shares, but almost all the non-voting ones. So they own nearly all the profits, but technically did not have control on paper. That allowed them to keep using the mining losses to cut taxes. But the court looked deeper. The judge found that Madison and Vanak worked together as one unit. They made joint decisions, installed their own directors, moved the head office to their building, and managed all operations. In reality, they controlled everything. The judge said they had fundamentally transformed the company. New owners, new business, and new assets and new direction. That's exactly what the law against loss trading is supposed to stop. So the tax court applied GAAR and said you cannot use those old losses. The deductions were denied, unfortunately. Here's what business owners can learn from this case. Spinning out assets or shifting businesses must have a real commercial purpose, that's the main word, and not just tax savings. Control isn't just about votes on paper. CRA looks at who really runs the company, who makes the decisions, hires staffs, and manages the money. Non-voting shares don't protect you if you still control the business in practice. So intent matters. If the main purpose is tax reduction, CRA can reverse it using GAAR. At Cloudriver CPAs, we help businesses design corporate structures and reorganizations that are smart, defensible, and CRA compliant. We test your plan for GAAR, risk, ensure every step has a valid business reason, and make sure your records tell a clear story. So Before you buy, merge, or restructure a company with old, valuable losses, talk to us first. Cloudiverse CPAs in Burnaby is your Google Maps for corporate tax, helping you get there safely and confidently. I'm Amandeep Singh, CPA. Thanks for watching, and I'll see you in